Hey team, welcome back to the channel. It is Fabio, and in today's video I'm going to be doing a breakdown on how to identify supply and demand with two simple methods. One, we're going to be using 50% body candlesticks. This is an indicator that I use on a daily basis. It simplifies the method of identifying supply and demand zones. And number two, we're going to be using the so-called buy before the sell and sell before the buy method. Inside this video, we're also going to be identifying a potential trade setup, and it's going to help you understand exactly how to enter the market using supply and demand. Now, without further ado, make sure to leave a like and subscribe, and let's dive straight in. Alright guys, so we're here on dollar yen for December, January and February of 2025, and by simply watching this video you will understand exactly how to identify supply and demand yourself. So as I mentioned, there are two ways to identify these zones, and we're going to start with the most easy way, which is just simply based on an indicator, where we're going to be using the indicator called the 50% body candle by Emmy Nuss. This indicator has around 3,000, I think this is likes or users. So all you simply want to do is load in the indicator, and when you double click on it, you can go to settings and make sure that you have the white candlesticks. Okay guys, this is just makes everything much easier when you use the white color as well, just like I'm doing in this video. Now, the overall rule to identify a supply demand zone is fairly simple. All you're going to be looking for is pretty much an area where you have white candlesticks based together or placed together, and what you want to do is take the two most recent candlesticks and draw them from wick to wick, or your zone from wick to wick. So what you have, for example, over here are 3 candlesticks, and what we're going to do is we're going to take the two most recent candlesticks and again draw the zone from the highest to the lowest wick. Now, extremely important guys, what you need is that after the basing structure, so the basing structure is just the white candlesticks themselves, you need to see a massive movement in a certain direction, because the bigger the movement away from those candlesticks, the stronger the overall supply zone will be. So what we can see over here is that we have the zone, the market comes back up in towards that zone, and then from there starts selling down lower again. Again, what we had over here are 1, 2, 3, 4, 5 white candlesticks. Take the two most recent candlesticks, draw the zone from wick to wick, extend the zone to the right, and again what you see is that it acts as an area of supply, which eventually pushes the market down lower. Now again, what we had over here are 1, 2, 3, 4, 5, 6, 7 white candlesticks, and again what we're going to do is take the two most recent candlesticks, draw the zone from wick to wick, extend the zone to the right, and here again you can see that we have that area of supply with absolute sniper precision. So that's how easy it can be to identify a supply demand zone, and it works pretty much all the time. Again, over here you have the white candlestick, and we only have one single candlestick, so it's not a rule that you need at least 2 candlesticks. One is also perfectly fine. And again, what you're going to do here is draw the zone from the lowest to the highest wick, extend the zone to the right, and as you can see over here, we tap in not only once but twice, and then we sell off very hard back down in towards the downside. Now, this happens pretty much everywhere. You see these white candlesticks always pretty much provide a reaction. As we can see over here, it provides a reaction, and as we can see over here, when it acts as a demand zone with these two candlesticks over here, we extend it to the right, it acts as an area of demand, which again in turn pushes the market up higher. Now, these supply and demand zones will always be the strongest when you trade in line with the overall trend. So what you can, for example, see is that we have a trend in towards downside here, so it pushed down. Here we see an overall correction, here we see an overall push down, and then again we see a retracement before again another impulse down. Now, very simply said, let's consider this over here a break of structure in towards downside, right? That would mean that this here is your high, and let me just press the replay mode for you guys real quick. So we have the break of structure. This here is your break of market structure. This here is then the area of supply that you have from the highest to the lowest wick on the two most recent candlesticks. We extend the zone to the right, and what you can pretty much see, by the way, is that this zone over here was formed with the help of these two imbalanced candlesticks, again acting as an area of supply. This is just really how clear it is and how often it actually happens. Again, the basing candles, strong push down, acts as supply, and then again pushes the market down lower. So what you then want to do is you want to wait for the market to retrace into your supply zone. Again, if we also draw in the Fibonacci retracement tool, for example, over here, you can see, okay, we get a very nice 618 Fib retracement. In addition to that, this supply zone over here, which we are now looking to short from, also was formed on the basis that we took out 2 equal highs over here. So this over here is a liquidation zone, automatically making the overall area of supply just a little bit stronger. But today we're going to keep it nice and simple and just focus purely on identifying those supply zones. This here is our supply zone based on those imbalanced candles. And what you see is that the market retraces into your supply zone. And in addition to that, we also have that nice fib level, as we mentioned, and that liquidity. But for now, let's just focus on that supply. So the market comes into a supply zone, and then what you want to look for is the change in market structure. So here we have the high break, here we have the low break, and again we have the 50% body candles from where we see a strong impulse down. Again, draw a supply zone on the two most recent white candlesticks and draw the zone from wick to wick. Now, what you can then simply do is just place an entry on top of the supply zone, stop loss above the highs. We target a new lower low, and what you will see is that the market will pull back into that supply zone, and then eventually what happens again is that we have how many? 1, 2, 3. So sometimes what you see is that if you refine the zone like this to the two, again, most recent candlesticks, you could have even placed a skill in position again with your stop loss above the highs, once again targeting a new lower low, because this is ultimately in line with the trend. Now see how precisely we tap in towards that zone, and from there we start selling off again. Now once again, this, for example, over here, these two white candlesticks would be your new area of supply, where if you would want to skill in again, you could place an entry like this, again targeting a new lower low. Let's see, do we get tagged in? And we do. Yes, we do. So we get tagged in, and then eventually the market reverses back up higher. So overall, on those first two positions, a 1 to 3 risk to reward would have been hit, which is the overall target that I use when trading these supply and demand zones. And then this second entry over here, obviously when we formed a new area of consolidation that we had over here, then this limit would have been removed overall. So this is pretty much the first method that I mainly use to identify supply or demand zones, and which is fairly mechanical and simple. Now, the second method that I personally love using when identifying supply and demand is known as a buy before a sell, or a sell before a buy. Now, very simply said, what you just simply are going to be looking for is a buy up before an even stronger sell in towards the downside. Now, what you see here is a buy up and then a very strong sell back in towards the downside. We retrace, and then again we push down lower. Now this is a fairly easy method, because all you need to look for is just again a buy up before an even stronger sell down. It kind of takes away any guesswork that you need. You just need to look for a buy up but then a very strong sell down, and then again you can identify that you had an area of supply over there. Again, another good example could be this zone over here where you have a buy up, so you just simply take the entire buy up for the whole sell down. Just take the entire buy up like this, you extend the zone to the right, you just draw the zone, by the way, from the highest wick to the lowest wick of the entire buy up for the sell down, and then pretty much you have a big area of supply. Now the thing is, when taking these entire zones, the problem is often that you're going to have a very wide stop loss. That's why I personally prefer to just wait for a new buy before the sell to be created within the overall larger zone. So what you, for example, could do or could say is that here again we have a buy up before a strong sell down, and that is then going to be your refined area of supply from where we can then take a sell position in towards the downside with your stop loss above that high, targeting a 1 to 3 risk to reward. So as simple as that, those are pretty much the two methods that I use. Now this was for a supply zone. If you're looking for a demand zone, we look for something called a sell before a buy. Now a good example could be over here where you get a strong sell down before a stronger buy up. So we get the strong sell down but then a stronger buy up, market comes in and then pushes back out again. Again, very simply said, over here if we zoom in, you can see a sell down before a buy up. So here we have the sell candle down, but then you need a strong buy up engulfing that sell candle. We tap back into that demand zone and then we push up again. So it keeps on happening time and time over and over again. Fairly simple method. Over here we have a buy up before a stronger sell down, again acting as an area of supply. So these zones are extremely powerful, but you need to use them in combination with the overall trend and understand what the overall trend is doing. So when the market is trending in towards the downside, look for those supply zones in the form of a buy before the sell down. Let's say the market is trending upwards, then you're going to be looking for a sell before a buy. So here we have an overall market that is trending in towards the highs. Then again, you want to be looking for what? You want to be looking for the overall sell before the buy. So that's, again, fairly simple. This is the entire sell before the strong buy up with this engulfing candle. And then you can see here that that acts as your area of demand to push the market up higher. So this was it for today, guys. Just a quick overview of supply and demand, making you and helping you understand how you can apply these zones on a daily basis. No BS education, all super straightforward and ready to use for yourself. If you have any questions, let me know in the comment section down below. We also have a free Discord server where you can ask questions on a daily basis as well. The entire team is active in there. Also, if you want to learn this strategy with my help, there is a link in the description of the video, and I hope to see you in the next one. Have a beautiful and blessed week or day. Thank you.